Did you know that the S&P 500 index is the first US market cap weighted index? Well, many experts believe that it is important for every investor to understand what the S&P 500 or Standard & Poor's 500 is if they want to become successful. While you may have already heard about the S&P 500 index, there are still some shocking facts you didn't know. Due to the depth and variety, the S&P 500 is widely considered one of the best gauges of large US stocks and even the entire equities market. Here it is important to note that you cannot directly invest in S&P 500 because it's an index, but you can invest in one of the many funds that use it as a benchmark, tracking its composition and performance. There are a few interesting points that you must consider about S&P 500 because they might help you in increasing your chances of profitable investing. Hey guys, welcome back to Money Invests, where we discuss everything about money, investment, and personal finance. I'm going to show you some shocking facts about S&P 500 that you did not know. In the end, I will also tell you what successful investors say about S&P 500, so make sure to watch this video until the end. For now, I'd like you to do me a favor. Change the color of that like button to blue by smashing it. With that out of the way, let's talk about it. Facts you didn't know. History of S&P 500. The Standard & Poor's 500 was actually unveiled in the year 1957 as a stock market index to track the value of 500 companies that have their stock listed on the NYSE and the Nasdaq Composite. This index covers around 80% of the market capitalization for the US stock exchange. Around $10 trillion worth of money is indexed or benchmarked to this index. Of this, around $3.4 trillion includes indexed assets themselves. S&P 500 provides financial data, credit ratings for investments, and numerous equity indexes. There is a strict criterion for inclusion in this index. The group of stocks that make up the S&P 500 is intended to signify most of the composition of the American economy. As a result, the value of the S&P 500 and numerous stocks within the index is closely observed by investors since their performance signifies a gauge of the health of the American economy. Investors frequently use this as a guideline to observe how investments perform, like mutual funds, real estate, bonds, and various other types of assets. The S&P 500 holds the stocks across all 11 stock market sectors, from technology to consumer staples. The exact mixture and weighting of the numerous constituencies within the S&P 500 are adjusted as the economy changes, and a few stocks have been included and detached from the index over the years. Now, the interesting point here is that stocks are not randomly chosen to be added to the S&P 500. Instead, there is a strict standard for being included in this index. Even the giant tech companies have to meet the S&P 500's list of requirements. The board reviews the companies every quarter in order to verify whether the companies have the capability to be included in this index or whether to retain the company that is already a part of it. How does a corporation get added to the S&P 500? In order to get added to this index, a company should be a U.S. company and should have a market capitalization of over $14.6 billion, be highly liquid, and have half of its shares should be available to the public. The corporation should also be running in profit in the current quarter earnings, and the sum of its sprawling 4 successive quarter earnings must be positive. From 1957 to 2021, the S&P 500 returned an average of 10.5% yearly. Not adjusted for inflation. It means that if you had invested $10,000 in the year 1957 and did not touch it until 2021, then your investment would be around $6 million. Due to its best return ratio, this index is, without a doubt, the best possible option for anyone who wants a simple and easy investment. The surprising thing about this index is that the 10.5% return was just an average, which means that the index also returned much higher than that in some years. Like in the year 1990, the index returned around 19% to 34% until the bubble burst in 2000. While during some years, the index also had negative returns, like in the year 2001, when the return ratio was minus 13%, and in 2002, the ratio was minus 23%. In the next 6 years period, there was varying profitability, and in the year 2008, the market declined around 38%. Then there was a recovery in the next some years. You might guess that the S&P 500 is quite expanding holding, but that's deceptive, because the index merely holds the biggest companies in America. However, this leaves a large number of fast-growing small stocks behind. The top stocks are Microsoft Corp, Apple, Amazon, Facebook, Google, Johnson & Johnson, Berkshire Hathaway, and JP Morgan Chase & Co. What about the profitable small businesses that are not included in this index? Well, this index has undergone 36 corrections since 1950. By now you're thinking, have you subscribed to the channel? If not, subscribe and share the video with your friends. Sector breakdown. Do you know that the S&P 500 holds many technology companies, as this percentage is about 25.7%? However, healthcare makes up 15.4%. And communication services make up 108%. The sad thing is that this index holds very few utilities, energy, and consumer staples that have only a percentage of 3.3%, 3%, and 7.4%. Moreover, famous companies like Google, Apple, Facebook, and Amazon make up over 30% of the whole index. Now imagine for a minute that if the technology sector is going down due to any reason, this would adversely impact the returns of S&P 500 substantially. Dividends payment. When you own an index that tracks the S&P 500, you will get the regular dividend that you can choose to reinvest in the index or spend on something else. If you choose to reinvest your dividend, this will make a huge difference in your overall investment in the future. As I have already mentioned that S&P 500 has an average return of 10.5%, but this includes dividends, which means that this would be your average return if you automatically reinvested all dividends payments. So if you've chosen not to reinvest, then your average dividends return would be around 6.6%. If you invested in the S&P 500 fund, you will receive a dividend of almost 1.5% annually. For instance, if you have invested $100,000 in this fund, then you would receive $1,500 in the form of a dividend. However, the actual yield changes slightly as the market prices vary, and companies upsurge or decline their dividend payments. The major reason behind these variations is that this fund holds a majority of tech companies, which pay relatively low dividends despite high growth in stock prices. It is simple to invest in S&P 500. Owning the S&P 500 is as simple as it gets when it comes to investing. Funds that track the index are offered by all main investment corporations like Vanguard, iShares, Fidelity, and many others. The best possible option comes down to which offer has the lowest expense ratio or the fee charged for the investment in the fund. There are plenty of variations of the S&P 500 that you could invest in. As you could invest in an S&P 500 growth fund that holds stocks held within the index that places more emphasis on growth with greater risk with high distribution to Tesla, Nvidia, and many more. Alternatively, there are S&P 500 dividend funds that hold companies within the index that pay high dividends, such as Chevron and Iron Mountain. There are equal weight versions that allocate an identical percentage of the fund to each corporation. Moreover, the funds aim towards more steadiness and lower instability that only pick the most stable companies held within the index, such as J&J and P&G. I'd like you to share your favorite stock in the comment section below. If you want to invest in this fund, then you should be prepared for a large decline in its price as well. If you are trying to invest in this fund, then you should be prepared for a large decline in its price at any time. Bear market, or when the prices go down at 20% or even more, happens almost every 3.5 years. Luckily, these bear markets tend to be comparatively short-lived, lasting an average of about 289 days. This means that a large portion of the time you're invested, you should predict to be in the bear market. If you understand the bear market as a normal part of investing, then this could become a great opportunity for you. If you're fully prepared with sufficient savings in an extended time, often investing in these periods could increase your long-term returns because you're buying the fund at a lower price. Famous investor Warren Buffett gives special importance to this fund. Do you know that Warren Buffett is a big fan of this index fund? In 2017, Warren advised consistently buying S&P 500 low-cost index funds. He also added that you should buy it through thick and thin, and particularly through thin. In May 2022, Warren also said, in his view, the best thing for most people is to buy this fund. Please support this channel by subscribing, and I will see you at the Golden Gate.